Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Canada's trade deficit widened by more than expected in November. Data from StatsCan showing the country had a trade shortfall of $2.2 billion, with total exports falling 2.8%. Shipments of metal and non-metallic mineral products posted the largest decrease, and both exports and imports of motor vehicles and parts saw declines. Gold has been the most significant contributor to the fluctuations in exports, with larger shipment declines to the UK, US, and Hong Kong. Celestica shares are taking a hit. Look at that. They're off by 15% right now. Analysts are highlighting the company's increased capital spending as well as its disappointing full-year outlook. Celestica is boosting its planned capital investments to $1 billion for the year. On the upside, revenue and profit in the fourth quarter beat expectations, and there was an increase in revenue driven by continued demand for AI data centers. Shares of Caterpillar are higher today. They're up about 0.67, but today, if you're in the green, you're doing okay. This after the manufacturer reported profit and revenue in its latest quarter that surpassed estimates. The beat was driven by the sales of power generation equipment to AI data centers. Caterpillar's power and energy segment has now become its largest and fastest growing unit. It has helped to offset a sharp decline in profit from the company's traditional segments of heavy-duty machinery, which builds and works in the resource industries. Taking a look at the markets, you might actually not want to take a look at the markets right now. They are having a very off day right now. The TSX down by 1.38, and south of the border, similar situation, red all around. Look at the S&P 500, which had been flirting with 7,000, has pulled back almost 1.5%. The Dow off by 0.7%, and look at the Nasdaq right now, off by 2.53%, and that is a tech stock sell-off. It's driving most of this today with those earnings. Earnings season is underway, and our next guest says after an epic year for the TSX in 2025, January has had a strong start until today. We're joined by Jerome Haas, partner at Lightwater Partners. Jerome, thanks very much for joining us today. Just get a reaction to what's unfolding on the markets for today, at least.
Yeah, it was an ugly day in the markets. It's nice to get away from the office when you got a sea of red today, so I enjoyed the walk over here.
Is that strictly on the tech stocks driving that?
I think it is. There's a lot of sentiment and a lot of momentum clearly in 2025 went into the AI theme. It's inevitable that it can't continue going up in a straight line. So some of the sell-off we've seen, Celestica's 15% sell-off is partly a reflection of that too, because it's been very focused on the AI data centers.
Okay, let's talk a little bit about the TSX in general. It outperformed last year, was up by about 4.6% going into today. I think a lot of these numbers will be going into today. How is it looking? Usually they say as January goes, so goes the year.
Yeah, well, if you recall, we had a strong January last year, and then we had a sell-off like February, March, and April. April sort of bottom of the market, and then we had a very strong year to finish the year. We wouldn't be surprised to see a scenario like that play out, because to us, when you look at the economic and you look at the political headwinds that the world and Canada is facing, it's kind of hard to justify why we were up 4.6% month to date.
What are your big concerns for headwinds?
Well, look at gold, for example, and gold has been a refuge because of the political uncertainty and the economic uncertainty. But it was a snow day on Toronto on Monday, and I was shocked that gold hit 5,000, and then today it's up 55, or yesterday it was. That's a heck of a move in 1 week, and a lot of money has rushed into that. The bank stocks were up phenomenally last year. They're trading at 14 times. They can't really value much higher than that. So where's the money going to go? And we actually have concerns about that, and we think there will be an outflow out of equities.
We just, I don't know if you could see that last chart we had, but it was for gold, and it in the last hour it's taken a turn. It's off by more than 1%. So you have concerns about equities. What's the big worry?
Well, we just think valuations are stretched across the board. The mining sector and gold pulled things up last year along with the banks. Gold doesn't seem to have today as an exception, but just seems to be going up and up. At some point, people have to say, what is an ounce of gold really worth in absolute terms? And 5,500 seems to be pretty expensive in our standards for an ounce of gold. So if that reverses itself, then what is going to propel the Canadian market?
So how are you balancing things then? What are you looking at? What are you looking for?
Well, we don't own, we're focused on Canadian mid-cap stocks, so we don't own any banks at any time. We don't do resources other than oil and gas, so, we don't have any gold exposure. Oil and gas has done very well, and part of the reason for that is actually a risk premium. Despite the economic headwinds, I think there is a risk premium being factored into oil and oil stocks, which is one of the few bright spots we think in what we look at.
And with the mid caps, I mean, there's been so much focus on the large caps. Are you seeing people start to turn to them as maybe a way to kind of balance things out?
In a word, it hasn't happened in January. There's been a real dichotomy between some of the stocks that we look at and what the market's been doing. And one of the examples we quote is Fairfax, which is one of the bigger stocks which we would own within our portfolio, and down 15% this month. It's probably the worst performer on the amongst the financial or diversified financial stocks in Canada. And that's a pretty big move for a stock of 48 billion market cap.
But you like it. And what else do you like about it?
Well, we've always been drawn to the valuation. I mean, it always has traded at a significant discount to its peers, Intact, Financial, and Definity. It trades currently at about 1.2 times book, which we think is the metric that people should be using. In comparison, Intact trades at about 2.2 times, so almost double the valuation for that, despite the fact that Fairfax is a little bit bigger in size than Intact. And even Definity, which is about the quarter the size of Fairfax, actually trades at about a 50% premium to Fairfax's price-to-book valuation. So we just see that here's a stock that has a stated goal of growing its book value by 15% per year. Since 1985, so that's a 40-year period, the total return for this stock has been 19% per year. That's a phenomenal return on a long-term basis, and yet, it's off 15% this month and trading at half the valuation of its peers.
That's getting into Warren Buffett territory. Wasn't he 20% over per year over like 60 years? That is quite the run.
Yeah, well, and Prem Watsa is often called the Warren Buffett of the North, but the irony is that the stock trades at a discount because of Prem. So instead of the Prem premium, it's actually a Prem discount because they're a lot more reliant on the equity markets, a la Warren Buffett, than their peers. And so as a consequence, they trade at a lower valuation. Is that justifiable? You could make the case for it, but I think half the valuation seems a stretch to us.
Okay, and let's get the other one in here. Main Street Equity. What are you liking about that right now?
Well, when you think about it, the number one issue among Canadians is affordable housing, and this is a direct play on affordable housing in Canada. Main Street is the largest player in Western Canada among the mid-market segment, and that's a euphemism for stocks that are what they buy are generally stocks that are not stocks, rental residences and units that are rather run down. They fix them up and put them back in the market. So their average rent is about 12,500. And the Canadian government's making a lot of noise about building affordable housing. So if you try and build a purpose-built new affordable housing, it's going to cost you $400,000 a door. So to justify that investment, you need rents of $3,000 per month. These guys are less than half of that. They've got approximately 20,000 apartments in Western Canada, and to us, it's a really attractive play. It's again a very strong long-term performer. That was a laggard last year. It was down about 9% when the TSX was up 28%. It was down 2% going into today. So it's been a laggard this year too, but it's a great long-term performer.
All right, we'll wrap it up there. Jerome, thanks as always for joining us.
Thanks for having me, Roger.
Jerome Haas is a partner at Lightwater Partners Limited. Coming up, Canadian Pacific Kansas City profit fell in its latest quarter. We'll take a closer look after this. Canadian Pacific Kansas City says profit fell in its latest quarter against a challenging macro backdrop fueled by trade uncertainty between the U.S. and Canada. For more on this, I'm joined by Ari Rosa, senior equity analyst at Citi. Ari, thank you very much for joining us.
Absolutely. Thank you for having me.
What was the biggest number of concern for CP Kansas City?
As you mentioned, the overall macro environment continues to be challenging. And so that's certainly a concern. But honestly, I actually would take a slightly different take than your framing. I mean, I thought in the context of a challenging macro environment, I thought this was actually a pretty decent result. Canadian Pacific continues to lead the industry in volume. It continues to lead the industry in earnings growth. And so, it provided a solid outlook against that challenging macro backdrop. And frankly, I think it's a stock that's well positioned when we do get some macro recovery, when we do get some tariff resolution, which hopefully should come in the next 6 months. We'll see. We've been here before, but I think the stock is actually quite well set up from these levels. And frankly, the valuation isn't particularly stretched either, and that's one of the reasons that we like it. So clearly, there's some challenges. That's been true for the entire transportation complex, but. Of those names within our coverage, I think actually Canadian Pacific is one of the more attractive ones.
All right, well, let's talk about it from that way then. What did they do right?
So they're controlling costs very well. The service is very good. Safety metrics continue to be near industry best. And so, in Canada, folks are probably familiar with Keith Creel, their CEO, but he's really considered one of the leaders in the industry and has, despite the many challenges, despite the many uncertainties, I think they continue to execute well. And I think, again, that sets them up really nicely for when we get a little bit of recovery in the macro.
And is there indications that we could start to see a recovery this year? I mean, we have CUSMA coming up, negotiations, a lot of uncertainty still.
Yeah, that's one of the challenges, and that's where we're a little bit more cautious. And so, in fairness, we think, look, there's not really a lot of reasons to get excited about the near term, but for people who have a decent investment horizon, who have, a year, 2 years plus holding period, we think this is actually a really attractive entry point. Again, the rails have not really participated in this rally. I heard your prior guest. I tend to agree with him. I think, look, stocks across the board tend to be pretty expensive, but within our coverage, at least, rails are actually pretty reasonably valued. And again, if you're looking for kind of that growth at a reasonable price type of narrative, I think CP fits quite nicely into that bucket.
And what other headwinds might they be facing along with CUSMA? I guess concerns always if there's a slowdown.
Yeah, certainly. So there's, of course, there's the tariff pressure. There's broader macro pressure, and we were talking about how housing, construction, end markets have been weak. Intermodal has been a bit of a challenge. You've had pressure on a lot of end markets related to construction, so metals, minerals, forest products, certainly. But then conversely, you've seen some strength in grain. You had a record Canadian grain crop. That tends to be rather profitable for CP. And so we think that kind of keeps them going as you work through this period of challenge. And then hopefully in the second half of the year, you see some uplift. And then the more encouraging part really is that they're doing a really nice job controlling costs. And so you saw the industry-leading operating ratio, which is really just the inverse of the operating margin. That was quite strong for Canadian Pacific, despite that kind of tepid backdrop.
And what are they doing when it comes to cost control? What are some of the things they're implementing that are making this difference? And can they continue doing that?
Well, you're seeing headcount reductions, right? And so that perhaps is a reflection or a concern for the Canadian economy, but you're definitely seeing headcount reductions and efficiency gains as a result of that. You're also seeing them really leverage their equipment, and because the network is running very well at the moment, and that's not only true for Canadian Pacific, frankly, it's true across the North American rail landscape. They're running with some of their best service levels in history, and that's improving asset turns, it's improving equipment efficiency. And so you're really seeing them get the most leverage out of that among their peers. And so again, the margins look okay in the context of what is otherwise a fairly challenging backdrop.
All right, and you mentioned for the short term going into 2026, still up in the air. When do you think we might see a turn, or you might see indicators that they've turned the corner?
Yeah, so it's interesting because it's not unique to CP. It really is a number of stocks in our coverage. We've heard this from UPS. We've heard it from Union Pacific. We've heard it from others where they're kind of talking about this tale of two halves. And it's, pressure in first quarter. Obviously, we've had a little bit of a difficult start to the year in terms of the winter, and that tends to present challenges for the railroads. But as we start to move into, spring, summer, that should hopefully carry through in terms of some benefits and some uplift to earnings. The other thing that's impactful, which we haven't talked about, is you're seeing, at least in the U.S., you're seeing really tightness in the trucking market. And that should hopefully carry through to better volume growth and better pricing for the rails.
Now, we just had, we talked earlier about automation and with trucks. Is that coming to rail as well? And how much of a difference would that make? Would we see no engineers in a train?
Well, it's interesting. We've done some work around this, and look, people have been talking about autonomous trucks for a long time. Well, for the better part of the past decade, we've been hearing about autonomous trucks and the threat that they pose. The reality is, I think both from a regulatory standpoint and from a technology standpoint, it remains quite a way away. Probably not something we need to worry about in the next cycle. The other thing, as you point out, is, if you think about autonomous technology, it makes a lot more sense for rails than it would for trucks that are moving on the highways. And so we think there is some efficiency opportunity to be gained there. At the same time, it's not really something that folks are terribly focused on right now. I think the regulatory hurdle, frankly, poses, at least as far as the rails go, the regulatory hurdle poses a bigger challenge than the actual technological hurdle to that.
Okay, well, we'll wrap it up there. Ari, thank you very much for joining us.
Thank you.
Ari Rosa is Senior Equity Analyst at Citi. Coming up, Canadian food conglomerate Empire will be shutting down its customer fulfillment center in Alberta as its grocery delivery business disappoints. We'll take a closer look right after the break. Canadian food conglomerate Empire says it will be shutting down a Sobeys fulfillment center in Calgary. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Coming as a bit of a surprise.
It's a bit of a surprise. I mean, we're talking about Voila here. I think you've seen those light blue trucks. We see them in Ontario. They're around doing the deliveries. And still will be in Ontario and Quebec. We're talking about out west, where really sales for online e-commerce for Sobeys have not been doing so well the last couple of years. So Empire, the parent company of Sobeys, announcing that the closure of this warehouse in Calgary will happen. There's actually a small one in Edmonton too that's closing. And Empire saying the company will be taking a $750 million write-down on the business, saying that these online results just really weren't what they expected. They haven't met the company's financial expectations. So again, we're seeing this one in Calgary close, one in Edmonton close as well. And then Voila will continue operating in Ontario and Quebec. And the company says they see these operations growing steadily out in central Canada, but really out west in Canada, just not doing as well as expected. So it's interesting to see the the change over the years. But yeah, that's the news today, and Empire taking a bit of a hit because of it. Not so much.
And did they say why the people had just stopped ordering?
Yeah.
Any reasons? And
well, they
steady a sudden drop off. So many questions.
I know there's so many questions, and there could be so many different factors. They haven't said a specific reason. They just saw like out west they weren't doing as well. There was actually a warehouse that was being built in Vancouver, but they paused that building of it as well, just saying that out west they're just not seeing that kind of revenue coming in. Actually, in 2024, when Empire first paused the building of that Vancouver warehouse, the CEO at the time said the company was losing more money than they had initially estimated, and that it's actually masking the strength of its brick and mortar stores instead, because most grocery stores still doing better with foot traffic than they are online, even in Ontario and Quebec. But the warehouse in Calgary started in 2021, I believe, so right in the thick of COVID.
Yeah.
And so it was doing okay back then when a lot of people weren't going out and going to grocery stores and shopping. You said you were the same. You ordered your groceries during COVID, but not now. And so apparently that's a trend out west. It could be population as well. There's just a smaller population.
And maybe
density.
Like,
it's so hard to get around. We're in Toronto right now, and it's hard to get around, right? So it's easier sometimes to get your groceries ordered. But it's an interesting development. And Loblaws also, I was just checking, another Canadian company, not seeing those sales in terms of e-commerce and delivery as they are in terms of foot traffic.
Okay, Lindsay, thank you for that.
Thanks.
BNN Bloomberg's Lindsay Biscaya. Well, we have some fresh information today on the Canadian economy and Canadian households. Here to help break it all down for us is Kamal Karamali from CTV News. Kamal, thanks as always for joining us.
Yeah, anytime, Roger.
Okay, first data set, Canada's trade deficit, big jump.
Oh, huge jump to $2.2 billion is the gap between imports and exports. And that, just to give you a sense of how big of a drop that is, month over month, that is for the month of November. In October, that deficit was $395 million with an M, now dropping in the month of November to $2.2 billion. So let's take a look at that gap. So the number of imports fell just 0.1% to 66.1 billion. But it's the exports, 2.8 billion, 2.8% less than the month of October, down to 63.9 billion. And the difference between the two is a gap of 2.2 billion, just a massive drop month over month. And things had looked good for a couple of months. The trade deficit had even seen a surplus in September. But Trump's tariffs on steel, automotive, aluminum, and lumber have hit these critical sectors hard. So the biggest contributors on your next slide here shows you really where this deficit was driven by. I want to show you the right of your screen, the exports when it comes to metals and non-metallic goods, specifically gold, dropped significantly, nearly 25%. Take a look at that number. And then vehicles, probably to no one's surprise, because of the tariffs and the trade war and the back and forth, the up and down, 11.5% drop in vehicle and vehicle parts exports. When it comes to imports, though, we saw a bit of a trade-off here. So these are showing firm numbers to that trade war where the U.S. imports dropped more than 5%. But take a look at that green arrow going upwards. The imports of other countries picked up significantly, Roger. In fact, 7.8% is a record high in terms of a monthly import for Canada from countries outside of the United States. So a bit of a trade-off happening. We've heard about it from the Prime Minister and the current Liberal government that they are relying less on the U.S. and more on other countries. Well, that data from Statistics Canada shows you that it is taking place. Fewer imports from the United States, but more record highs from China and Germany and other countries outside of the U.S.
Okay, and some more numbers to digest when it comes to the growing gap in household incomes.
Yeah, I want to just quickly touch on this because those two things might be related. There is a huge wage gap that is increasing month over month and year over year. So taking a look at 2024's Q3 wage gap specifically, we saw that it was 46.3% in Q3 of last year, now jumped up to 47.5%. So the gap that Statistics Canada looks at is the highest 40% earners versus the lowest 40% earners in Canada, and that gap is now at 47.5%, and it just seems to be growing. The factors: weak wage gains, but a growth in spending, as well as declining interest rates. Although that makes borrowing and lending rates lower, it also means that there are lower returns on investments. So that income gap growing, Roger.
Okay, well, wrap it up there, Kamal, but thank you for that.
Anytime.
Kamal Karamali of CTV News. Coming up, as gold and silver prices soar, we'll do a deep dive on the precious metals sector. Stay with us. Shares of Rogers Communications are moving higher, up about 3.23%. That's after revenue and profit in the latest quarter topped Bay Street estimates. The results were helped by the telecom's investments in the Canadian sports industry, essentially the Toronto Blue Jays and that big deep playoff run they did to the World Series. For the full year, Rogers is projecting revenue growth of up to 5%. Tesla shares are seeing some pressure, off by 2.3 right now. The EV maker reported a 61% drop in annual profit and also saw some revenue slip compared to the year before. Tesla has been dealing with growing competition and has cut prices in a bid to boost sales. The profit decline marks the second straight drop for the company. Tesla is now leaning heavily on bets in AI and robo-taxis to drive future growth. Shares of Lockheed Martin are rallying after posting a full-year outlook that beat estimates in both revenue and profit. It's up more than 5% right now. The outlook comes after the defense company recently signed a 7-year deal with the Department of War to provide more missile interceptors. The company's CEO says 2025 saw unprecedented demand that is already being seen in 2026. Sell-off today having an impact on the markets. The TSX, I want to say bouncing back, but it's not down as much as it was just a little while ago. It's still off by almost a point. And south of the border, it is a similar situation unfolding right now. Everybody in the red, but a little bit of a recovery. But the S&P 500, after flirting with 7,000, down a percentage point. Dow off by 0.24, and the NASDAQ is off by 2. And of course, everybody's talking about gold and silver. They have been soaring lately. Gold hit 5,550 this morning. Silver nearing 120 US. Here to tell us more and do a deep dive on the precious metals sector is Lawson Winder, Senior Metals and Mining Analyst at BofA Securities. Thank you for joining us, Lawson. Let's just talk general. I mean, gold, it's going crazy. And then you look, and then silver is actually ahead of it.
Yeah, look, I mean, we think there's a lot of reasons for gold's performance and silver's. If we look at gold, I mean, as a firm, we've been calling for gold to reach these levels since it was well below $2,000. And ultimately, our thinking was the twin deficits in the United States. You have a trade deficit, and then you have a budget deficit. And you know those two on their own are a very compelling reason to hold gold. Giving risk around the U.S. dollar and U.S.-based investments. But, you know, a couple of other things have happened since gold was well below $2,000. I mean, one is you've seen central banks materially step up their buying of gold to the tune of well over 1,000 tons a year, which is the highest in the historical record that we keep back to the 1950s. You've also seen the Chinese real estate market collapse, and so you've seen Chinese investments step up. And then you have dependable India. So Indian consumers and investors continue to buy gold at very strong rates.
It's one of the largest markets, is it not, for gold?
It is. China and India account for about 60 to 65% of total consumption of physical gold in any given year. So yeah, very important markets.
And also, I can't remember the name of the company, but there are companies that are starting to hoard gold now, as like actual physical gold. They have vaults of it.
Right. Yeah. So a tether.
I think I saw $23 billion worth of gold they had, like actual.
Yeah, that's right. I mean, it's a significant amount of gold. I mean, the other sort of institution in terms of physical gold investments is the GLD, right? The ETF, and I mean that certainly is a popular vehicle with a lot of investors. What we like to focus on is specific stocks, but certainly we see a lot of our institutional clients choosing to get investments to physical through the ETFs.
And with everything the way it's going, where do you see gold continue on its rise? And then we're going to bring silver and maybe some other precious metals as options in as well.
Yeah, absolutely. The conditions have led gold to almost $5,500 right now haven't really changed. If anything, I mean, they're starting to accelerate. And what I mean is, the concern around the twin deficits in the U.S., those continue to be very real. And for a lot of investors have become an even more real concern in recent months and quarters. The other thing is that financial stress has started to increase, and then geopolitical conflict has started to increase. And these are the things that investors tend to like about gold. Now, central banks, we think are largely indifferent to a lot of this stuff, but they continue to buy at very strong levels, despite the price being as high as it is. Typically, you'd see them target a certain value of gold, but actually volumes have remained relatively strong, despite the value of gold that they're purchasing almost doubling.
Okay, and silver, it's a lot more volatile. It's outperformed, but is it still on its way? It's up 60% in the last month.
Yeah, it's nearly doubled since late last year. So it's really surprising performance. But I think what's happening is it's riding gold's coattails as an investment to protect against a lot of these things that we've discussed. Silver is a bit of a different metal than gold. So gold, most of it goes into vaults, it goes into ETFs, it goes into various jewelry boxes around the world, particularly in India and China. Silver, though, about 60% of silver is actually consumed in industrial applications, mostly around electrical and electricity. So that remains the case. And then one particular application that's been a really big source of demand for silver has been photovoltaic, so solar panels.
Solar panels, yeah.
Yeah.
Okay, and let's talk about some of the companies you're liking with everything that's unfolding around here.
Right. So as we were discussing on the break there, Pan American Silver is a company that we like. We recently increased our price objective quite materially to $73. At the time, there was well over 35% upside. The shares have rallied very strong. It's approaching that target, but it doesn't necessarily mean that the shares can't continue to perform well. So, just to give you an idea about why we like Pan American, first off, it's a very diverse portfolio of silver and gold assets. So it gives you a balanced exposure to both metals, both which we like, as I discussed earlier. But in thinking about where we are today on Pan American Silver, the more that silver and gold continue to rally, the more upside potential there is. So we think about mark to market on estimates. So just thinking about putting the current spot price of silver and the current spot price of gold through our models, we'd be looking at a doubling of our current 2026 EBITDA versus our current estimates, which were set just 2 months ago, and a tripling of our free cash flow estimates. And so that leads to another reason why we really like this stock. And many precious metals, to be fair, but we particularly like Pan American with its both silver and gold exposure. On these mark-to-market levels, they have the ability to return a lot of capital to shareholders. So we saw a fairly significant capital return in 2025 to the tune of about 175 to 200 million. We see the potential for that to very, very materially step up in 2026, particularly on spot prices. And then just finally, this is a company that has a lot of unused assets in their portfolio. So they have a mine in Guatemala that's not currently operating, but would be the third largest silver mine on the planet, would it to operate. And they're working with the government on getting that mine restarted. They also operate a project in Argentina, which hasn't been able to get permits for almost 2 decades.
Oh, wow.
We have a new government in Argentina that's doing a lot of work with the mining sector, trying to get a lot of these projects built. So 2 pieces of value that we see unpriced in the shares today that present a lot of upside.
Some good reason for optimism.
Yeah.
All right, we have to wrap it up there, but Lawson, thank you very much for joining us. We appreciate it.
Thanks for having me, Roger.
And that's Lawson Winder, Senior Metals and Mining Analyst at BFA Securities. Coming up, the record-breaking rally in commodities gained fresh momentum as gold, copper, and silver hit new highs this morning. But we have seen a bit of a pullback in gold. We'll get more on that when we come back. Well, investors have a lot to chew on this morning, aside from earnings from tech heavyweights, Meta, Microsoft, and Tesla. Gold futures neared 5,600 an ounce for the first time ever. Silver contracts also hitting record highs, and copper scaling new heights. Earlier, we got some perspective from Lyle Stein, president of Forvest Global Wealth Management.
They're looking for some protection from all the geopolitical concerns, all the potential inflation concerns, a whole bunch of reasons. But it goes even beyond gold in some respects, Andy, because you're looking at big moves in other commodities. Silver, you mentioned, and as you go down the list, copper, and even the last week, we've had oil run. These are all hard assets. And from a portfolio manager question, it's interesting. What do you do with all these hard assets?
What do you mean? What do you do with them? How do you play them?
Exactly. So, look at pick a chart. It doesn't really matter which one, but we might as well go with gold because that's 54.50 or whatever it is today. The stock has gone what we refer to as parabolic. It just looks like that old hockey stick, right? Where it's got a short shaft and then a long staff.
Yes.
It's interesting. But how do you play this? What do you do in the context of a portfolio with gold stocks, but with commodity stocks, hard asset stocks in general? And it's a big question. Now, as you know, we've held gold in our client portfolios for a long time. It's been a wonderful place to have been. But today, at current gold prices, what do we do in our portfolios? And, we believe gold has two roles. It's got an insurance component, and then it's got sort of a investment, call it momentum mode. That's more the stocks as opposed to the insurance is the hard bullion asset. And so in our client portfolios, what we're actually doing is taking some of the wonderful gains that we've made in our gold stocks and moving it more into the insurance component. And so, when we think of gold positions, roughly we're 10% in the gold commodity, the insurance, and 15% in the stocks, where we had been shifted much more towards the stocks over the course of the last 2.5 years.
That's interesting. So, sorry, just to make sure I had that clear. You still have a good weighting in gold, the metal, but you're moving into the stocks. So you're overweighting the stocks right now, relatively speaking?
Other way. So we had been much more exposed to the stocks because of the leverage you get from the operating businesses. But now with gold running the way it's been running, we're leaning more to how do we get more insurance into the portfolio? So let's own the bullion directly.
Right. Copper is on fire as well. And apparently a lot of that is speculative activity in China. Copper topping $14,000 US a ton for the first time and surging in US trading as well, as we can see, up 10%.
Yeah, and we see that as a result of two factors. Number one, the world's central bankers, the world's politicians are doing what's called running the economy hot. They're putting fiscal stimulus in, and they're trying to keep interest rates low. And so you've got this whole demand side into a world of copper mining where there just isn't mining capacity to meet the demands for AI needs, for electrification needs through the entire grid. And so what happens is the commodity stock goes up. I mean, I can't explain the kind of moves that goes from 6 to 653, essentially overnight. But the basic copper story is that it's in long-term deficit supply, so prices will have a bias to go up in that environment.
Yeah, Bloomberg is saying today that copper is being fueled by intense speculative trading in China, and people who have no interest really in copper as a metal piling in because they see momentum here.
And I'm not going to cast judgment, but silver is kind of in that same camp too.
Right.
It's an industrial metal. It benefits from economic activity, but there just isn't enough physical silver to meet the needs of the speculators when they're in the market transacting every day. And so what happens, you get these parabolic moves. And the question is, it's wonderful to ride on the upside, but we all know what happens on the downside, and it tends to fall quite quickly as well.
It looks as though the tech earnings, broadly speaking, were pretty good.
Yeah, well, it depends on the company, right? We had Meta on the upside, but the big one is Microsoft, which markets weren't too happy about. Now, we own neither of them, but we were looking for in those numbers is what are they saying about CapEx? Because the whole AI CapEx spending boom has been driving not just the stocks, but the U.S. economy. They say half the growth is coming from AI spending, and Meta, which was in the doghouse not too long ago because they were going to spend more than the anticipated revenues, is now going to continue to spend, but everybody's happy because they had revenue growth. On the other side, on Microsoft, you didn't see the growth that people were looking for in their cloud business, and they didn't like that. So the world is changing there, and it is becoming much more, I think, and this is perfectly indicative of what we refer to as a stock picker's market. We own Amazon, Google, and Micron. We're looking at these names carefully in the context of what Amazon and Microsoft are saying with respect to CapEx, because it impacts everybody.
It looks an interesting. I'm actually looking at the story on this Microsoft in the Economic Times of India. They highlight something that apparently new disclosure revealed that OpenAI accounts for 45% of Microsoft's backlog of $625 million. I presume a lot of that is cloud business, but that's interesting that you're so exposed to a company, OpenAI, whose debt is raising eyebrows among investors.
Well, and that's a big question for the whole sector, is how much debt is being taken in. And in particular, in the case of Meta, Meta is doing the financing of a lot of their development of AI centers off the traditional Meta balance sheet. It's off the books kind of thing. And there are questions as to how willing the lenders will be to continue to provide the kind of capital that Meta needs. I mean, you look at Meta's forecast of $115 billion. Just last night, I looked up how much Canada as a country spends on that kind of spending. And in 2023, I think we were at maybe $350 billion Canadian. I mean, Meta is half of that for all practical purposes. It's quite amazing how much money is actually being spent. And, if they build it, will they come? We've all seen the movie.
Andy Bell was speaking with Lyle Stein, president of Forvest Global Wealth Management. And coming up, revenue and profit in the latest quarter at Rogers Communications topped expectations with a big assist from the Toronto Blue Jays. We'll take a deeper dive right after the break. Revenue and profit in the latest quarter at Rogers Communications topped estimates. The results were helped by a certain baseball team. For more on the story, we're joined by Stephanie Hughes of Bloomberg News. Stephanie, thanks very much for joining us. I didn't want to ruin the surprise about what the special team was. That certain team.
Oh, I'm sure there's no, exactly. Yeah, I'm sure there's no surprise there, Roger. There was a lot of hype just being in Toronto around that time with all the packed sports bars. A certain Bluebird, the Toronto Blue Jays, are leading Rogers to really report some strong fourth quarter results today. So they pretty handily beat analysts' expectations with their earnings in the fourth quarter, and to end off the year, those adjusted earnings of $1.51 per share handily beat what analysts were expecting, which was closer to $1.42 per share. Unsurprisingly, media segment did most of that heavy lifting since they really expanded their sports empire last year by doubling their stake in Maple Leaf Sports and Entertainment. But that, coupled with the success of the Toronto Blue Jays postseason and making it to the World Series, really gave it some more oomph there. So the media revenue climbed by 126% since last year, bringing the revenue level to it's a triple-digit gain. I had to double-check that to make sure it wasn't a typo, but it hit $1.2 billion. So the total revenue also got a double-digit boost from media, obviously doing the heavy lifting, whereas areas like wireless and cable were a little flat, which kind of makes sense when you look at Canada's population growth. It's trending lower after federal government immigration curbs. That means the company has a smaller pool of newcomers to tap to actually grow subscribers. So most of their growth obviously coming from sports media. And investors are taking this well. I'm looking at the share price right now. Earlier today, the stock traded by over 6% at its highest point. That was the biggest intraday gain since July. So it's been a few months since we've seen this level of enthusiasm, Roger, and it's almost matching the level of enthusiasm sports fans has for the Jays this last year.
I know, a lot of pressure for next year. You were in on the conference call. Any standouts from it?
Yeah, I think the biggest standout, and it's probably not much of a surprise given what we're talking about, but the direction that Rogers is taking. They reiterated their plans to basically lean further into that sports empire by buying the remaining 25% stake in MLSE. So Tony Staffieri said that the financial results today really position the company well to pursue that stake, which they said that will help really grow the value and help retain customers, since they probably want to have a cable provider that will broadcast these games. So they also, on the other note, based on the wireless side, they also flagged that there was some heavy promotional activity during the Black Friday season in December, where a lot of their peers really dramatically cut pricing for their mobile plans. Rogers didn't quite follow the price cuts there, and as a result, ended up having lower subscriber growth. Comparatively, like other telcos, like I mentioned, they're grappling with a lower Canadian population. So to compensate for that, Rogers said it was focusing on tapping some underserved markets, more notably the rural areas that don't have as much network concentration as the cities, Roger.
All right, we've got about 35 seconds. What did the analysts say?
They're taking it pretty well, either a neutral or positive tone. Scotiabank's analysts had an interesting commentary saying that they said that the street's loading expectations, subscriber loading expectations, are just way too high considering the expectations for population growth and the heavily competitive industry. So last week they did cut the price targets for all the major telecom providers. So all in all, looking for more growth out of sports, and that's about it, Rogers.
All right, we'll wrap it up there, Stephanie. Thanks very much for joining us. Stephanie Hughes of Bloomberg News. Market calls coming up next. Today on the show, we have Richard Orrell. He is portfolio manager at RN Croft Financial Group. He'll be taking your questions on exchange-traded funds. And that's it for Morning Markets. Thanks very much for watching. Have a great day. We'll see you tomorrow.